You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Hello, Jim.
Since when did we think all of a sudden lower gasoline prices would be a news item? I mean, very nice for the average driver, but what's lower petroleum prices going to do to the Canadian economy?
Yes, well, that's a good point. I've heard a lot of discussion today in the last few days because oil just breached $80 a barrel. That's WTIC, West Texas crude, broke below 80 today, and our technical work, my partner's technical work on it was that, that's basically been in the cyclical uptrend since the 2009 recession kept it above $80 a barrel, and a breach below 80 suggests that you're now in the mean reversion phase again where, the downside long-term target is in the $40 a barrel range. That's sort of secular support, and a lot of people are, can't believe it could ever get that cheap, but then they're not really looking at it in the full context of a secular cycle. So it began from $10.79 a barrel in 1999 and went to that all-time whack job $148 a barrel in the financial crisis when assets were highly overvalued, corrected back to just under 50 a barrel in the 2009 recession. And so now that it's back testing that line, if it breaks below that, that's where you sort of get confirmation that this secular boom is over. And I think that lines up properly with all the other factors that are going on, namely, an incoming recession in many of the developed economies around the world already, on top of which you've already had weak demand since the last recession. The statistic is that the American economy is pumping out 56% more oil than it did prior to the last recession, and the consumption in the U.S. is off 8%. So you can see that there's a huge amount of supply on the market, and all these innovations coming out of the commodities boom when everyone was investing tons of capital into all the different strategies and technologies to get different commodities out of the ground during the boom phase have really given us some great advantages in the sense of now oil or fuels that were not accessible or economical, previously were accessible in the past few years. So you've had this huge glut of supply come onto the market, just as you've got a rise in alternatives, more energy efficient equipment and products so that you're using less. On top of that, as we've discussed before, you have a weak consumer because of the debt overhang. So you really haven't had a rebound in demand. So you got a very interesting dynamic going on in energy markets today, and people are sort of saying, but isn't that good for the economy because it's good for the consumer? And I say, yes, indeed. In a slow growth world where we really have to help consumers have to, hunker down, spend less, pay off debt, sort of build back up their balance sheet, lower energy prices are going to be helpful. But in the bigger picture, in the sense of a lot of economies and governments in the world have factored in, they need for example, the shale boom in the United States, many of the projects need a break-even cost of above 80 to make them viable economically. Venezuela needs around more than $100 a barrel for oil to make their numbers work, and you see that can create a capital crunch in a lot of areas in the world, and for different, as I say, producers who really haven't factored in any of this and have just been hoping, they were buying into the idea of peak oil and hoping that oil prices would never come down, and I think that's not the case. I think we're going to see significantly lower oil prices as we go forward here, and that's going to put a cash crunch on the expenditures that were, slated for many of the budgets, even in a country like Canada. So yes, it's good for consumers. It's not so good for the revenue side and for the taxation side, as you say, for, places, some areas of Canada in particular.
Yeah, especially Vancouver, where we have the highest gasoline taxes. The transit authority relies on those gasoline taxes to subsidize their buses and SkyTrain. But of course, when those taxes go down, I'm fearing that they might hike fares to make up the difference. And of course, how does that help consumers?
Yeah, but you see, you're absolutely right, Jim. But the reality is that we've been in, the high beta rich. Robert Frank's book talks about how we've become this economy that's dependent upon asset bubbles in the sense of municipal and provincial and state and federal budgets have all been predicated on collecting property taxes and consumption taxes off of a certain proportion of the population, and it's dependent upon these asset valuations going up and up and up. And in doing so, meanwhile, it crowds out many of the productive uses of capital that people could be doing if they weren't overpaying for things like energy and housing, right? So people have had a lot less money so the economy becomes much less diverse, much less robust from a revenue basis. They're all, doing their books based on assumptions about continued escalation in some of these commodity prices and taxation off of some of those commodities and, housing and property taxes. The problem is that, you do need a mean reversion in that because that's the only way the economy can reset. In other words, as soon as these bubbles pop, then the budgets drop into the toilet again, because revenue disappears and there's no sort of diverse, broad-based, healthy economy underlying that to provide revenue from other sources. So it's a nasty correction phase. It's a nasty process that has to take place, but at the same time, it's the only way we get back to a more sustainable environment, in my view. So, it's like we were talking just before the call about the car industry and how, there's a stat going around that if you look around the roads today, there's a stat that I've heard quoted many times in sort of the industry literature that cars today on the road are the oldest that they've been in many years. Think about this for a second. So they say the average age of a car on the road today in North America is 14 years or more. And does that drive with your own experience when you look around? And I would suggest it doesn't. In fact, most people are driving around in relatively new cars. And if you look at why that is, it's because the car companies, after the Great Recession, were, first of all, in the credit bubble boom, they were producing more cars than ever before in human history, way more than the average, almost double the long-term average, and way more than anyone could actually afford on sort of conventional financing, So what happened was then after the recession, they were so desperate to get back to pumping out their product that they found all these creative ways to get cars into the hands of people with zero down, zero rates, as we've talked before, 7, 8, 9-year car loans. So, leases, I mean. So what's happened is that now no one can afford to buy used cars. In other words, the masses have been given all these sweeteners to reach for new car leases. But if you go to buy a used car, well, you need 20% down, and it's a typical financing arrangement, and you're tending to get a higher interest rate, and so people can't afford to buy used cars, so they've been leasing all these brand new cars. Well, it may sound like a great idea. In the short run, you get a jump up in cars moving off lots, but in the long run, you've saddled the consumer again with more debt, more obligation on a longer term basis, and they're not ever getting that asset paid off so that they have excess income to spend on other things. So you can see again, in the short run, these solutions seem like they help. In the long run, they actually make the growth and the demand potential weaker and the balance sheet of the consumer and the country weaker. So they're very defeating, self-defeating. Same thing with the QEs that have been pumped out the past few years. All this obsession with bankers and central bankers, getting free money and buying up assets. At some point, and I believe we're there, the gig is up because people realize that although it has created more asset bubbles, it hasn't filtered into the real economy, and in many ways it's made us worse, more vulnerable. The central bank to the central bankers, the Bank of International Settlements, the head of it was doing a speech in Sydney this week, and he said, you know what, the world is now much more precarious than it was even in 2007, because we have, much more debt in the system, we have much more risk-taking, we have all these asset bubbles, and we don't have any substantive improvement in the balance sheet, which is really what we needed to do to get, built back up for the next recovery phase.
And also, I was thinking with electric cars, one of the attractions is lower energy prices to run your car. But when you have gasoline prices falling to these levels, what's the incentive to buy one of those very expensive electric cars where you have a huge cost to start with?
Well, the technology, first of all, the technology for the electric cars, especially for something like Tesla, is mind-boggling, okay? It is revolutionary, it is world-changing. But as with all those things, as with seatbelts, as with, anti-locking brakes, as with, airbags, all of these things first came out in the very high-end vehicles. That's always been the case because they're new technologies, they are expensive to get started, and they have to be bought first by the high-end who can afford it. But all of them eventually then trickle down to the mainstream. And even a company like Tesla, although it's got a very high-end product at present, has a plan to have a $30,000 kind of sedan available on the marketplace within the next 5 years. So it's not that it's not going to be accessible by Joe Public eventually. It's just that in the short run, there's a lot of costs when you create something truly revolutionary. And
if you want to bypass a central charging station, why not put solar panels up on your garage roof?
And they are, you see, and they're putting charging stations around all over North America that are solar powered. So you are going to be able to access literally free energy, not just for the consumer who plugs in, but for the grid itself. This energy is going to be free. So again, it's a longer term solution, but it's one of the ideas that's critical to this whole process of getting the world weaned back off of this completely negative waste of energy, which is everybody obsessed with how do we get the black oil and how do we get the gas from it and how do we get this into the consumers. If you look around, we're all driving around supporting the traditional energy companies, but at the end of the day, if we don't have to pay that money out, if we don't have to, go put up with all the costs of pumping that oil out and pumping it all around and transporting it across oceans and all that, it's just a no-brainer. And the fascinating thing about humanity is we've been around for hundreds and hundreds and hundreds of thousands of years, and yet we still think of, the oil energy, the oil era as this, it's always been this way. It hasn't always been this way, right? It's like a couple of hundred years, essentially, that you've had this sort of petroleum era. So in the big picture, that's very small, and I remain very optimistic that we're going to move to a much more intelligent way of managing our energy and our resources as we go forward.
I believe in 100 years, people will say, you burned oil?
Yes, exactly. How ridiculous is that?
How silly.
Yeah, exactly. So, but in the short run, it's going to be a bit rough on Canada, I think, and that's why we're seeing the Canadian dollar, for example, which we've talked about. It's been a barometer for the whole global growth story since 2011, when global manufacturing turned down. The Canadian dollar weakened, and it's been following, lower ever since. So this week it breached again back to the indicators about where we are in this economic cycle. The Canadian dollar breached below this week its 2009 support channel. So coming out of the last recession, when the Canadian dollar sold off really dramatically, if you remember, from 115 at the peak in 08 all the way, into the 70s, 78 or so in the bottom of the last contraction, and then rebounded from there. Well, it's now officially below that trend it maintained from 09. And so I think that more weakness is likely, both because of energy, because it's been following the oil story down, the price of oil down. The venture exchange, Jim, is back where it was in the 09 recession. That's the resource companies in Canada. So again, it tends to correlate with resource companies, energy prices, Canadian dollar, all tends to move together. And then also the Canadian equity market tends to follow with some correlation to that trend. So I think, the overall market remains extremely overvalued in this climate, thanks to its 61% exposure to financials and energies, Jim. If anyone's trying to tell you the Canadian broad market is a diversified basket of of companies, 61% financials and energy. So weakness in both of those areas, which I think is highly likely given the valuations and given the slowdown in both domestic consumption because of the consumer credit problems at home, as well as the export interest in our products abroad as the global economy slows. All those things tend to suggest that we've got quite a bit. We've had a lot of volatility the past few weeks, but the TSX is, even with the rebound today, it's still negative on the week. And I think that we're well below the 200-day moving averages on all the major indices here. So even though I think there'll be tons of volatility and you might see some big green days like today, I think the trend is really in place here to have some some downside for the next period of time. And again, you may get some rally periods. You may get a rally even into the year end at some point, as would be common, but that doesn't mean that you've started into a new uptrend. In fact, right now, the downtrend is the thing to be paying attention to.
We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Danielle Park, author of the popular blog Juggling Dynamite. Danielle, any thoughts about the economic impact of Ebola?
Yeah, well, I know that there'll be a whole bunch of nonsense of people talking about, that the swoon in the markets lately has to do with Ebola. I totally don't think it's to do with Ebola. I think that Ebola certainly doesn't help. I think that it's typical to have, disease scares come out, and it does impact sentiment. People start thinking about not traveling and that sort of thing. So on the margin, it can definitely hurt certain economic sectors, and that can be negative because the economies are already weakening, and to have another reason for people to sort of pull in and not spend is not obviously going to be supportive of growth in this era. But I would say it has nothing to do with what's been going on in the markets. It's just one of those little, it's like a drip, 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 and is another factor that's weighing on concerns, but the leading edge of that is certainly the stock market. I would say that the stock market's behavior is a greater influence to any kind of sentiment than whether or not there's Ebola spreading in the country. Now, having said all that, I actually think we're underestimating the sort of longer term duration of how much Ebola is going to be around. It seems to be spreading in an exponential manner at the present. And if you look at the projections, they're saying by December 1st, they think in Africa you'll be getting 10,000 new cases a week. Those cases are not going to all stay in Africa, Jim. They're not now, and I don't expect them to then. So I think that, some of the plans that people have made for this winter, I'm starting to concern myself with what travel restrictions may be coming, because at some point people may want to stay home instead of, venturing off into the world. And again, it's not about hiding under your desk in terror. It's just about trying to be practical until they can get an antidote or a vaccine or, some kind of way to contain it. Basically, containment in our global village is pretty much impossible.
Sure. The next disease outbreak is just 8 hours away by jet plane.
Yeah, and I have to fly somewhere tomorrow, and I'm just thinking to myself, airports are not necessarily the place you want to be because they certainly are a hub for all these places coming in from all over the world. But again, it's not the scapegoat. I don't see it as the scapegoat for why we're having the difficulties in the global economy or why stock markets are extremely jittery and have been selling off. They've earned that through their hyperbolic moves over the past 2 years by their unfounded faith in Fed interjections as if the Fed would never let stocks go down and all that nonsense. That's what's earned this very negative phase, certainly more than anything else.
Danielle, thank you very much for chatting with us.
Thank you, Jim.
belated happy Thanksgiving.
Thank you.
Maybe we can wear off that turkey this week here in Vancouver, sloshing through the big puddles.
Yes, lovely.
Thank you again. My guest has been Danielle Park, and check out her blog, please, Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can also find us on YouTube. I'm Jim Goddard. Have a great day. Any comments about the show can be sent to info@HowStreet.com.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.